Welcome to the Wealth Studying Podcast. This is episode 473. Today is June 3rd, 2025. I'm your host, John Pugliano. I'm also the founder money manager at investablewealth.com. In this episode, I want to run through a litany of good economic news. Again, you're pretty much not hearing this anywhere, certainly not in the mainstream media, and not even in the glass half empty, gloom and doom alternative media. If you consider all the bad economic news that's been paraded in front of you over the last 3 months, well, now that the hard date is coming in, it's for the most part all been revised higher. Let's start with what I thought was the most controversial and economically manipulated piece of forecasting that came out of the Atlanta Federal Reserve last quarter, where their projections for first quarter 2025 GDP were not only for negative growth, but in some cases they were projecting well below 3% negative GDP growth. Now they had to go in and revise their model multiple times throughout the quarter because it was so inaccurately skewed to the large amount of imports that were coming into the country to, front run the tariffs, which just goes to show you how feeble their model actually was. But in the end, they came out saying, well, it's going to be negative, but it's not going to be anywhere near the, gloom and doom negative 3% that the media ran with for, about 6 to 8 weeks worth of, Chicken Little news coverage. And so in the end, first quarter GDP came out a negative 20 basis points, which is basically flat. Again, the media made a big deal out of it. But you know what? Do you know what the Federal Reserve has been forced to calculate for second quarter GDP, right? Because they were so skewed to the negative side in first quarter to kind of make their average look better. They're now projecting second quarter GDP growth, which is, what we're in the last month of right now. They're projecting 4.6% GDP growth. Now, that's probably as insane as the negative 3% they predicted for last quarter, but it just goes to show not only how absurd their modeling is, but also, again, how biased the media is against reporting good economic news in the, kind of political environment we're in right now. Do you see anywhere where the mainstream media, or again, even the alternative media, is out there telling you that GDP this quarter is likely to grow 4.6%. They're not making that much of a story out of it like they did the negative Chicken Little gloom and doom that we heard all last quarter. And I do expect that official number of 20 basis points of negative growth to get revised up because all the other numbers are coming in better than expected. Look at jobs. We've been hearing about all the layoffs, about how AI is getting everybody fired. And I just saw an article the other day that software engineers were among the least employed people right now. In fact, supposedly, new software engineer graduates had a lower employment rate than students that majored in journalism. Now, the only way I think that could be even remotely true is, we don't know how these journalist students are supposedly employed. Maybe they're all working as baristas. But in any case, we've heard nothing but bad news about the job market, whether it be layoffs or whether it be companies cutting back and reducing their job openings. Well, you know what? The revised numbers are all out, and unemployment is holding steady at 4.2%, which, if you zoom out in the big scheme of things on a historical basis, is below what we used to think of as the natural rate of unemployment. And even with that very low level of unemployment, guess what? Job openings as well as new jobs created all beat expectations in the most recent reports. And we don't have to stop at jobs. Remember all the sad sack bad news we heard about inflation and how Walmart and everybody was going to have to raise prices. Well, of course, prices are going up in some areas, but again, overall, inflation numbers, both core and headline, are coming in lower than expected. And for the most part, they continue to trend lower and very likely by the end of the year will get down to the 2% targeted inflation that the Federal Reserve wants. And how about the other side of it? Rising interest rates. You've been hearing for months that foreigners are selling you as debt No one wants to hold U.S. treasuries. And you know what? 10-year treasury is back under 4.5%, which in my opinion is actually a very healthy level. I mean, why shouldn't savers be paid a reasonable amount of return on the money that they don't have directly invested in riskier assets? The 10-year treasury around 4.5%, while it seems unfathomable to the millennial generation, let's just go back pre-financial crisis, pre-2008 housing bubble. Pretty much for the decade prior to that, the 10-year treasury was around 4.5%. And certainly prior to 2000, it was a lot higher than that. So no, I don't think current rates are out of line. They certainly don't show that foreign investors, or anybody else for that matter, isn't investing in U.S. government treasuries, contradictory to what's widely reported in the press. And really, what the press and the media should be promoting is the fact that we no longer have inverted yield curves. Do you remember going back to early 2022? Anybody that could get in front of a microphone was telling you that recession was about to happen at any moment because the yield curve was inverted. And that was in spite of the fact that generally recessions don't come for 18 months or so until after the yield curve is inverted, but that didn't stop them for more than 2 years telling us about the inverted yield curve, which did go on for an excessive amount of time. And guess what? We still never got a recession during that period. Well, at least not an official one. And you can understand that given the fact that no one in the financial industry wanted a recession, because that would ensure the fact that Tariff Man would have won the election, which despite all their efforts, he still did win. Let's go on from interest rates. What about the U.S. dollar? Yeah, again, no one wants to own the U.S. dollar. It's losing reserve currency status, yada, yada, yada. Well, what's the truth? Current levels of the U.S. dollar are either at or above the level that they were for the entire first term of Tariff Man. And again, zooming out, the really strong dollar that we saw over the past 4 years or so was a manifestation of the balance sheet manipulations that occurred post-pandemic. If you zoom out again long term, where the U.S. dollar is right now is about the midpoint that it's been at as it's fluctuated over the last 35 years. And again, taking out the exuberance of the post-pandemic era, the U.S. dollar today is at the higher end of where it's been for the past decade. Now, to the extent that the dollar has come down quite a bit, in fact, it's down probably more than 10% from its recent peak. But remember, that peak, that big spike in the U.S. dollar came after Tariff Man got elected, and there was so much enthusiasm about reinvesting in America, right? The big American exceptionalism trade that the media touted for a few months. So yeah, to the fact that the dollar's down, it's only down since about the peak that occurred in December, January on that post-election enthusiasm, and to the extent it is down, what that really means is it's effectively a stealth tariff. Lower U.S. dollar means that imports are more expensive, and so that would naturally discourage the purchasing and consumption of foreign products and be more beneficial for domestically produced manufacturing. And speaking of manufacturing and corporate profits and such, we've again been hearing for at least the last 3 months about how tariffs were going to crush corporate profits, because to the extent that corporations couldn't pass tariff costs onto the little guy, they were going to have to absorb them themselves, and that would degrade corporate profits. Well, we don't have the final numbers yet for first quarter, but pretty much I think, well over 90% of companies have reported. And you know what it looks like? And this number actually blows me away, because I knew it would be good, but I had no idea it would be this good. But it's looking like first quarter S&P 500 corporate profits are coming in at a 13% growth rate. You heard me right, 13% growth. That's unbelievable. But someone's obviously believing it, because look at the S&P 500. Again, all the gloom and doom we heard leading up to the retaliatory tariffs on April 2nd, and then the huge drop-off and decline in the S&P 500 and all the other indices over the following week or so. But since then, despite all the naysaying and all the negativity and all the projections of, the chances of a 75% recession and the market was going to continue into a long-term bear market, well, the V-shaped recovery, the S&P 500 is now up well over 20% from those April lows. And as an index, it's pretty much, less than 3% from its all-time record high. And what I'm much more optimistic about this year than I was last year, and really over the last 2 years, is that the complexion or the personality of the S&P 500 is different. It's not all focused on 5 or 10 companies. Yeah, tech is still holding up for the most part. I've certainly not sold any of my semiconductor companies, but we're seeing an overall broadening out of companies that are having higher profits and correspondingly higher prices in their stocks. The AI craze is moving out of the semis and the superscalers and into more the application companies. And even beyond that, look at how well, especially just recently, the mid caps and the small caps are doing. And as you've heard me say over and over again in the last month or more, industrials and utilities and things like materials, even financials, are doing much better than they had in the last 5 years or so. And I know, again, the glass half empty people out there are saying, oh, but since we are so close to a record high, it's going to collapse again. Well, it might, right? I can't predict the future. I personally would probably look at that as another buying opportunity. But here's the bottom line. Despite how high the S&P 500 is again, and remember, it's not the same players that are at record highs. So we're getting this broader diversification, and on top of that, there is $7 trillion sitting on the sidelines in money market funds, which is uninvested. You have to remember that a good half of the United States population that hates tariff man, right? They pulled out of this market. They sold their holdings earlier in the year because of the fear of tariffs. They certainly didn't buy during the April dip, and now they're mostly in cash, or they've invested in what I would consider very shallow, non-diversified overseas investments. I know a lot of people talk about broadening your portfolio and diversifying more by investing in, say, Europe. But the reality of the situation is you're not getting diversification by going outside the United States because the overseas financial markets just don't have the depth, the liquidity, or the overall diversity of the United States stocks. You just look at a few of our big players, Microsoft, Nvidia. Their market capitalization alone is larger than most countries' entire stock markets. But I digress. Bottom line, not only do you have half of the U.S. electorate not participating in the stock market rally and this $7 trillion in money market funds, but you also do have all those foreign investors which have pulled back from investing in United States equities, and I think they're going to find out what I just mentioned, that they're not as diversified by being in their home markets, and more of that money will come back into the United States. So hey, again, short term, I don't know what's going to happen. We're coming into the summer months. There's going to continue to be a lot of opposition, both in terms of legislative and judicial actions against the tariff man. And you're probably going to hear that second quarter earnings are so bad, but remember, they're going to be comparing that to the extraordinary 13% growth that we saw in first quarter profits. So yeah, it is likely we could get a pullback as we go into the dog days of summer. But again, bottom line, I would most likely look at that as a buying opportunity because I think long term, the trend in automation, digitization, and electrification is going to continue to drive the U.S. economy, especially as more national security critical manufacturing is brought back to the United States. Well, hey, as always, until next time, this is John Pugliano wishing you the very best returns.